ladies and gentlemen. Welcome to our first new format here at Investor Talk, an interview with Egon von Greyerz from Matterhorn Asset Management, a Swiss company that is offering storage services for precious metals. And yes, Egon, welcome here at our new format. And of course, we haven't seen since the Munich event. I wish you a great new year. I expect this to become a very exciting year for us in the metal business after really suffering some years, but I think it will be a very busy and exciting year. Do you agree?
Thank you, Jan. Yes, absolutely. Exciting, I think, is too mild a word for what's going to happen. I think, yes, there'll be a very volatile year. All the markets are turning. So I think there'll be a lot of shocks in the system, and a lot of people will be left behind. And we'll see the beginning of the biggest wealth destruction in history, probably. This is the beginning, because it's going to take a few years, but the bubble will start to burst.
Yeah, I read this in your latest article, and I think we saw already the beginning of this big burst when we watched the big swings in particular in the US markets in the past weeks. I have never seen such a big volatility before, and it seems to me that we see the start of a breakdown of this highly leveraged financial system. I think you agree with that.
Yes. No, the markets have turned worldwide. Some turned earlier. You take the DAX in Germany, it turned already a year ago, and it's down 20% since then. China, Hong Kong also turned earlier, and they're down 20, 25, even up to 30%. And a lot of other markets, including the US, have fallen since this autumn. But the market has turned, and in the last few days, yes, we've seen this volatility that we will see. The bulls, or what I call the perma bulls, the permanent bulls. I mean, they will try to buy the dips, and of course, we know that most of the trading, anyway, is program trading. In the US market, at least 70% is program trading, probably more. So they will go in and out on any break of any point up or down. But the trend has turned. We're in the way I read the market, we are at the end of a major super cycle. It's hard to say of what degree it is, but I would say that it's a degree that probably it's at least a 100-year cycle, or maybe it could be a 200-year cycle or longer. It doesn't matter. What we're looking here now, is something that, in real terms, markets, the way I look at them, will come down at least 90% or 95% even. In real terms means measured against gold. If we get at some point in this phase hyperinflation, the indices can be higher in inflationary terms or in hyperinflationary terms, but in real terms, the collapse is going to be massive, and it would be a real shock to the system and to investors, and we will, as I said, see the biggest wealth destruction in history. Now, I think so we've seen them move up in the last few days, but the trend is down. The trend is down long term. I think the next leg is down. Is going to come pretty soon. But of course, markets. People are always interested in markets short term, what's going to happen, etc. The way we look at markets is that the risk. We think the risk is at a maximum. The risk is at a maximum in the stock market, in the bond market, in the property market, and therefore people have to protect against this risk. We don't know how far it will go. I mean, in 29, when the situation was nowhere near as bad as it is now from a point of view of debt and many other factors, then the Dow went down 90%, and it took 25 years to recover. I think we'll see at least the same now. So that's the risk. Whether it happens tomorrow or the next day or in a year's time, I think it will be sooner rather than later. But whenever it happens, it's the risk is here today, and it's today that investors have to take protection against this risk, rather than hope that the central banks will save them this time too. Because I think you know, they've been used to this money, constant money printing with all the central banks, you know, the Fed obviously, and the ECB, and you know, the German and Japan and China, etc. I think next time around it will not have. They will print because they will panic, because you'll have problems in the systems everywhere. You will have problems with the banks in Italy, in Germany, and all around the world. So they will have to print. But I think it won't have any effect this time. Why should it have an effect? Because how can you create wealth by printing pieces of paper or pushing buttons to create electronic money? Of course you can't. So I think this time the market is not going to fall for another few trillions or more, tens of trillions or even more of fake wealth. And therefore, I think this time, sadly, markets will collapse and it'll be a shock to people.
Egon, how is it possible under those circumstances? And we know that the perspectives for this year or maybe next year are really dire, as you just mentioned. How is it possible that the share of investment gold in portfolios is still that low? I saw recently a number of 0.5%, 0.5%. Do you have any current numbers how much it is now? And any idea why it's low?
Yeah. Roughly the amount of investment gold in relation to world financial assets is just probably a bit below 0.5%. And it's because, well, there are many reasons. One, of course, gold has been and is suppressed. Number two, nobody understands gold. No bank is interested in or asset manager in actually proposing gold to a client because they can't churn commission on gold. So far, people have not, there's no fear in the market yet, as in, there's not, you know, these falls are just, people are just seeing it as a correction. So there's no question for the majority of investors to think about wealth preservation, but they will regret it. But, you know, nobody's going to look at gold seriously until it's on the front pages and until there's real fear in markets. And probably in dollar terms, gold has to go up to the old high or approach the old high in dollar terms, which is $1,900, before, you know, the press and the papers and the media start noticing it, and therefore the people also, you know, people, it's a herd mentality. Most people love to buy high and sell low, you know, so at this point, nothing interested in or sufficiently interesting in the gold market has happened. But also you have to remember that gold, you know, gold doesn't react long term to events, whether it's a stock market event or whether it is a political event or geopolitical event. Gold's reaction to those type of events is normally only short term. Gold reacts to the debasement or the you know, the falling currencies, so the debasement of the currency, which means that you know, all gold reflects over time is the debasement of the currencies. And since that is guaranteed, you know, we've seen that now for the last 100 years, all currencies have gone down at least 95 or 97 to 99% against gold in the last 100 years. So we are guaranteed to see that final fall of you know, 1 to 3% from here. And especially since we know that the situation in the world, the financial situation and the situation with debt and the risk of default is so great that central banks will at some point in the next 2-3 years start printing more than ever before. And that's why they are therefore in a way supporting gold. They will continue to print money, which is guaranteed to push gold up. And of course, once the COMEX or the futures markets and the LBMA, which trades in paper gold only on a massive scale, once they can't meet their commitment and people ask for physical delivery, from futures gold or into bank gold, then the gold market will break, and then it will really go up. At that point, it could go up hundreds of dollars in a day or more. So this is when gold will take off. That will happen in the next few years. It could happen in the next 6 months. It might take longer, but over the next few years, gold will appreciate significantly. But that's not, we are experts. We are not experts in gold. We're experts in risk and wealth preservation. And we see gold just as a consequence of our views on the world. That is that we know that we are at a higher risk ever in the financial system and in the world economy. And therefore, gold is your best insurance against this risk. So you're not, our investors, and the way we look at gold is not that you buy gold as an investment because it's going to go up a lot. You buy gold because you're buying insurance to protect yourself against the massive fall in financial markets and in asset markets that the world is going to experience in the next, let's say, 2 to 5 years or 2 to 6 years.
And if you look at some stocks, for instance, banking stocks, they seem to have the next big financial crisis already in the cards. We in Germany, we have the Deutsche Bank at a multi-decade low. You have to go back to the 1980s to find a stock price of the Deutsche Bank where it is right now. Greek banks, same. We could be close to a Lehman Brothers 2 event, and there are many black swans flying out there, and they are multiplying by the day. Which is among those big black swans the one that you consider the most dangerous one that could cause the whole system to fall down or to start to fall down?
Yeah. No, you're right. Banking stocks. I mean, banking stocks are down 75% in Europe since 2007, I think it is. The banks are bust. Let's face it. Deutsche Bank is bust. The Italian banks are bust. All the banks are bust. But there are so many risks in the world. So and so many black swans are risks that can just come out of nowhere that we don't expect. So therefore, to forecast what is actually going to be the catalyst or the trigger for this fall is really, irrelevant, because what you're going to look at is that we have a debt bubble in the world, a debt that can never be repaid, and we have a financial system that is insolvent totally, and global debt has doubled since 2006. And if you add to that derivatives, etc., you're coming up to a total debt and liability of $2 quadrillion. It's a figure that no one can understand because it's so big, and therefore that is the big black swan. That is the big risk. Now, what will actually make that burst? It could be anything. It could be an Italian bank. It could be problems with Deutsche Bank. I don't think Deutsche Bank will be the first, because the Bundesbank or the ECB will go in and support it because it's too important for Germany to go first. But eventually, Deutsche Bank is not going to survive, of course, nor will other banks. And if it survives, the money and the assets that are in there will be worthless, because either will have been bailed. First, the bank will bail in the customer money and grab the customer money, and secondly, they will print so much money that any money you have in the bank will not be worth anything. So the trigger can come from any financial event, like a bank. It can come from some debt default somewhere. It can come from a geopolitical event. It can come from more yellow jackets in Germany, or racial problems somewhere in Europe. Or a Brexit failure. But that is not the reason for the coming fall or collapse of market. That is just the catalyst, and that's why, as I said, the catalyst, in my view, is not important. What is important is that there are so many things that can trigger this avalanche which is coming, and you only need that last little snowflake to actually trigger it. And that last little snowflake to trigger the avalanche can be absolutely anything.
To me, it sounds like a miracle that the powers to be were able to keep the gold price that low for such an extended period of time. We talk about these topics for a couple of years already, and still they managed to keep it down. But as you just said, the black swans are multiplying. There are so many out there. We don't want to scare the people who listen to our program. We want to help them to protect their wealth.
But let me interrupt you there. I mean, the gold price is low, and it's and it will be a lot higher. But that you have to think about, if we measure against the U.S. market, which is the biggest in the world, gold. The Dow Jones since 1999, the Dow Jones
outperformed. I just saw that.
Yeah, it is down by 50%. So, and even with this massive rally of the stock market, it was down by a lot more in 2011. But even with this massive rally in stock markets we've seen worldwide since 2009, all stock markets are down considerably against gold in this century. So gold has actually been the best investment in virtually all stock markets in this century. And you take the DAX is down 20% since a year ago, and since September, gold is up 10% in euros, for example. So you've got to look at relativity also. Not yes, gold hasn't performed as well as it will do, but don't worry about that. You don't buy gold to make short-term gain. If you don't buy gold to trade in gold and make and take a profit when it goes up. You buy gold and put it at the bottom of your wealth pyramid as your insurance, as your wealth preservation, and you keep it there. But it will be more an insurance in my view, because you will also make a lot of money out of gold, but that's not the prime reason for holding it the way we look at it.
To come back for a second to the topic we had at the beginning with the percentage that one should have in his portfolio as a protection. We have so many black swans, and there used to be the old rule of the top 10% rule, 10% gold. The other 90% obviously should be bonds, cash, real estate, and stocks, but those are also highly leveraged, and as you mentioned, they will come down big time. What percentage would you recommend in those dangerous situations we are currently in that individuals should hold?
Well, first of all, most people in the world, even in the West, have debt rather than assets, so they have no money to invest in gold. But what I'm saying to people is that, and even you take Venezuela as an example, where you have going to have inflation. We had inflation 2018 estimated at a million%. If the people in Venezuela 10 years ago or 20 years ago had bought just a little bit, a gram of gold every month or whatever, which everybody could have afforded. I mean, a gram of gold today is only 35 euros, and people can afford it today. So at whatever level, even if you don't have a lot of money, you can put away a little bit of money into gold every month. You don't have to be super rich to hold gold. And when you get into a situation like in Venezuela with hyperinflation, and when people have no money and no food, and it's a desperate situation, I think that is a risk that we will see that also in the rest of the world, i.e. in Germany, in the US, and most of Europe, etc. And that's why whatever amount you can save, you do. If you have bigger financial assets, in my view, yes, Emma, you should put enough in. If you are, a wealthier person, you put enough in so you can actually fall back on that if your other assets collapse, i.e., so that you could actually live on your gold as it goes up. The way I look at it, but we are, more concerned than most people. I think 10% is an absolute minimum. I mean, the average with our clients, and we have, some big clients, average with our clients is about 25% at least. But there are people who have a lot more. Because what I have to ask myself is, okay, let's say you only put 25%. Where do you put the rest, as you said? What do you do with your cash? Stick it into Deutsche Bank or into an Italian bank, whatever, or put it into government bond. We know that all the governments are bust and will never be able to repay your money.
Yes, you don't have any, Egon, you don't have any safe havens again anymore.
No, exactly.
In the past decades, you always had a chance to flee, for instance, to the US dollar or to Southeast Asia, to Singapore or elsewhere. But now I think we are facing a real global phenomenon, the collapse of the paper money system on a global scale. And this is a totally different story.
Absolutely. No, yeah, I totally agree with you. And therefore, also, so I mentioned stocks and bonds, property market. I mean, that's a bubble everywhere. Here in Switzerland, you can get 15-year money for 1.25%. Maybe you can get the same in Germany. I don't know. But it costs nothing to finance a property, and that's why you have this massive bubble. So therefore, it's the way I look at it is gold is permanence, is durability. This is the only asset and only money that has lasted throughout history. And right now it's also insurance, because the financial system is so fragile, and therefore, in my view, you should have a bigger percentage of gold than ever. Remember, I'm not a gold bug. I only see gold as insurance. But of course, you've got to hold gold in a way that it's outside the financial system. And you have to have direct access to your gold. You mustn't hold it in the bank, and you mustn't hold paper gold or an ETF gold. You must have your own gold that you have access to. And I think and also remember, gold is instant liquidity. You actually have, you can, and we do for our clients, and other people can do. You can actually cash in gold straight away. So in my view, it's better to have gold today than money, because money, one day the bank will say, sorry, you can only take out 10 euros a day or 25 euros a day, because we haven't got any money to give you. And therefore, you don't want to keep the majority of your assets within a financial system, which is going to go bankrupt, or is the risky anyway of going bankrupt.
This problem with the banks we saw a few years ago in Greece, where the people woke up in the morning and finding out from the news that they were not able anymore to get their money out of the bank, only very limited amounts. I think we are running out of time, not only with our interview, but also with the time that people have to preserve their wealth. We don't want to scare them, as I mentioned before, but help them to protect their savings. If there's somebody listening to our program right now with no exposure to the gold market at all, but in mind or with the thinking that we could be right with what we are telling here, what would you suggest somebody to start with right now?
Well, I'll come back to, so I don't see gold as an investment, as I said. I see it as insurance and as wealth protection. And therefore, you shouldn't think about it from the point of view as an investment. You just got to think about it as this is the best way to protect yourself, because your other assets, if you have whatever you have in other assets, are likely to decline dramatically. So that therefore, the way I look at it, you buy enough gold so that you can actually live for whatever period you need to live on your gold. Because remember also, in the scenario that I see, a lot of people will lose their job, and pension system also, which only has stocks and bonds and property, will also collapse and not pay out the pensions that people expect to get. So therefore, you've got to look after your own insurance. And remember, when you buy fire insurance for your house or your apartment, you don't buy it because you hope that it's going to burn down. You buy it because if it burns down, it's good to have. And that's the way you have to look at gold. And because of the uncertainty in all other asset markets now, you need to have a bigger percentage of gold than you would normally have. And each one has to decide for themselves what they think is right. So I don't want to give a specific percentage. personally, and our clients have a very high percentage, but people should put whatever they feel is right for them. But I think it should be more than they actually initially think, because as I said, look at if you get the crisis I'm talking about, the gold is going to save them.
Yeah. Egon, let be this your final words for our first interview here. It took longer than anticipated, but I appreciate your time. And I hope we can do this more often in the future. And thank you very much. Have a good day.
Thank you. It's a pleasure to speak to you. Thank you very much.
Take care.